Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today. And what I'd like to talk to you about today is the new and improved 3 mil super cap. So, a lot of people have known about this for quite a while. It's been referred to as the 3 mil super cap or the new super tax rules. And more technically, it's known as Division 296. What I'm hoping to do today is give you a bit of a summary of the new proposed changes and then give you a bit of an insight into what we think about it, how we're going to address it, and how we've applied it to our clients. So after the resounding win at the federal election in May this year, the Prime Minister, Anthony Albanese, and Treasurer, Jim Chalmers, they've been determined to pass changes to the taxation of large super funds. Even though it wasn't a big ticket item in their campaign to get elected, since they got elected, it has been a big thing that they've been pushing. And look, whilst we've been monitoring the developments this year and thinking ahead, ultimately, we've just been advising our clients to sit and wait until the final legislation has been passed before making any drastic changes to their plans. Because we've held the belief that it just didn't make sense to act before the legislation had actually been passed. And, as it has turned out, not saying that we saw this coming, but as it has turned out, there was always a very real possibility of changes to the final legislation, just given the level of backlash that it was received with by, industry, opposition, lobbyists, those sorts of things. So for most of the year, it appeared as though the original proposed changes were destined to go ahead. That was up until the 13th of October, which, a bit of a surprise, Jim Chalmers announced a major winding back of the proposed changes and outlined the new proposed changes to the taxation of large super funds. Now, I'd just like to make one comment about, the government's handling of this. There's been some people commenting that this was the plan all along and it was a classic bait and switch type operation. Now, to explain what that is, a bait and switch is where you go out and make a really big statement or a big change, big proposals, and everyone has backlash on it, and then you wind it back a little bit and you meet somewhere in the middle and everyone thinks, oh, that's not as bad, thank God it wasn't what was proposed, and they end up being happy with the final result. A good example of this is Trump in his sort of tariff negotiations. He throws things right out, far out, and then winds it back and then meets in the middle somewhere, and then everyone seems happy with it. So that's what a bait and switch process is. I don't think that that's the case at all. There's been a few people thinking that is the case. I think this is reputational damage. Not to get too political here, but coming out and having to wind back on these changes that you were so staunchly wanting to go ahead with, I think there's more damage there. So I don't think this is the plan at all. And no, so I don't think it was a bait and switch. Now, it's important to note that the new legislation still has not passed the Senate, and we're still awaiting to hear the finer details of the legislation. There's a few things that they haven't ironed out. And look, it is, it's still a possibility that there could be further changes to come. So, I just wanted to declare that. But however, based off the current information, this is what we know. So what were the originally proposed changes? So let me map this out for you. So simply put, there was an additional 15% tax to apply to earnings, that's a key term there, earnings, in super above 3 million. So as an additional 15% tax, anything sort of, is usually at a 15% tax rate on income in super whilst in accumulation phase, and then really anything from 2 to 3 million, because you could technically have 2 million in pension phase, which would be tax-free, but then anything from 2 to 3 million currently is at a 15% tax rate. So then there's an additional 15% tax rate when you go over 3 mils, so that puts you at a 30% effective tax rate on income. But the interesting point here is it's earnings. So whilst the additional 15% tax was to apply to income, realised gains, but it was also to apply to unrealised gains. And this is the important point, which I'll touch on this a little bit in a moment, but this has been widely spoken about, but that's a big change there, being tax on unrealized capital gains. So no capital gains tax discount was to apply to the unrealized capital gains. So if you have, as you know, in personal name, if you have an investment in personal name, hold it for 12 months, you get a 50% capital gains tax discount. Inside super environment, it's a third discount. So it turns a 15% tax rate to 10% in that sort of accumulation phase. So, but when it came to these earnings being taxed, and on unrealized gains, there was no capital gains tax being applied, so it'd be on the full amount. Then the other important point here, which was very contentious, was the 3 mil super cap was not indexed, so it was going to remain fixed indefinitely, we assume. So that was a big point of contention, which I'll touch on in just a moment as well. And then the final point was the commencement date was to be the 1st of July 2025. Now, that has been changed. That's with the new proposed changes, it's been pushed out to 2026. So let me start by saying, look, these original proposed changes, they were, as I've said, met with pushback and controversy, and that's for two main reasons. So, firstly, the taxing of unrealised gains. It's an entirely new method of taxation, really, that goes against the foundation of our tax system, and it creates a range of negative implications for individuals and for the broader economy. So, you think about it, many self-managed super funds own property, which are obviously illiquid assets, and can't be sold down incrementally to meet the demands of this new tax. Many Australians also own farmland and business premises through their super funds. So a tax on unrealised capital gains would likely have required many to sell these assets, causing people to, lose control of their properties, which inadvertently would impact their businesses. Super funds that predominantly own property already face liquidity problems, as I discussed in a previous episode, the liquidity trap, whilst they're in pension phase. So there's a liquidity requirement in order to meet pension payments. So there's already constraints on the liquidity of super funds. But this new tax just would have amplified that, given there is a taxation being applied on unrealised gains. And the other element here is that super funds, particularly self-managed super funds, they're a common vehicle to invest in smaller startup businesses in Australia, which are typically not publicly listed and they're illiquid in nature. So it's a really kind of lock-up arrangement there. And, industry lobbyists, rightly, I think, argued that the proposed tax would really hinder the private investment into this sector, which, this sector plays a really important role in, the innovation and growth of our economy. So there's that impact to consider as well. And now, the second big issue with the previously proposed changes was that the 3 mil cap wasn't indexed. So, in the same way, if you think about concessional contributions, non-concessional contribution caps, they're indexed and they've been increasing over time. And we're seeing this problem of bracket creep, that idea of bracket creep whereby, you're looking at the personal income tax rates, they've hardly changed. I mean, the government had made minor changes to the sort of lower income tax bracket, moving it from 16 to 15 to 14% sort of thing. But really, across the board, there's been a huge amount of bracket creep for people in terms of the personal income tax. So this would have been the exact same type issue for people over time, which meant that more and more people would have been impacted in years to come by the 3 mil threshold. So in his press releases, the Treasurer pointed out that only roughly 80,000 wealthy Australians currently have super balances over 3 mil, which equates to 0.5% of super funds in Australia. However, you've got to look ahead here. I mean, that might be so currently, but analysis from the Financial Services Council, and there's a lot of industries and bodies that have done analysis on this, but the Financial Services Council indicated that over 500,000 Australians would likely breach the cap in their lifetime, and of that includes about 200,000 Australians that are currently under the age of 30. So, you've just got to think ahead about the impacts of not having this indexed, and that was met with, big backlash. And I think that also really brought young people into the debate here because, I think there's, trying to win the vote of younger people. And it might be, giving this indication that, it's only the older generation, the very wealthy. It doesn't, this is going to help the sort of younger generation. But a lot of the analysis that was done actually says, well, hey, look, 30 years ahead, 30-year-olds now, you're the ones that are going to be adversely impacted by this. So I think it's sort of that was met by pushback from a lot of the younger generation too. And look, the final concern here, talking about the previously proposed changes that wasn't really spoken about as widely in the media as the first two issues with it, but one that I wanted to mention was there was a big issue there in terms of double taxation. So the government had not really addressed the issue of tax being paid on both unrealised and realised capital gains. So from what we understand under what was proposed, super funds would have likely been required to pay tax on the capital growth of investments before they're sold and then tax on the capital growth after they're sold. I mean, so that's classic double taxation there, which they hadn't really addressed and would have been quite unfair. And I mean, it would have made, I think, in my opinion, fair and logical sense that some sort of tax credit or tax offset would apply from the unrealised capital gains tax that you've already paid, which then work towards, offsetting the realised capital gains tax when you eventually go to sell the asset. But, this was never really addressed on the previously proposed legislation. Okay, so now let's fast forward up to the 13th of October in terms of the new changes, proposed changes, and what they look like. So let me map this out for you. The removal of taxation on unrealised capital gains, that has occurred. There is still an additional 15% tax on income and realised capital gains above 3 mil, bringing the effective tax rate to 30%. The existing 33 or third capital gains tax discount will apply. above 3 mil. So that brings the effective capital gains tax to 20%. There is now also a 10 mil cap, which is not something which was discussed previously. So there's the introduction of an additional 10% on income above 10 mil, which brings the effective tax rate to 40% for those very few with super funds pushing above 10 mil. So the existing 33% capital gains tax will apply above 10 mil. So that would bring the effective capital gains tax rate above 10 mil to 26.6%. Finally, the indexation will apply to both 3 mil and 10 mil caps, which is going to be in line with the consumer price index, which is currently about 3.2%. And that tracks, the other caps that are indexed as, the concessional contribution cap, the non-concessional contribution cap. So both of these caps are going to be indexed in line with CPI. And finally, the commencement date is the 1st of July. There was issues there because we were pushing into the previously proposed changes were going to be retrospectively dated because they were still being discussed in July, August, September, October, and then people were going to be hit with tax retrospectively, which started as of 1st of July 2025. But the commencement date of these new proposed changes is July 2026, which gives people, some time to, put their strategies in place. So the new proposed changes, they've widely been accepted as much more reasonable and acceptable than the prior proposed changes. And look, this is namely due to the removal of tax on unrealised capital gains and the indexation of the caps. And, also that third element that I thought I spoke about has been removed here, the double taxation. So now that we've removed the taxation on unrealised capital gains, it's, inadvertently removed the issue of double taxation there as well. So really kind of all three concerns are better under the new proposed changes. Now, whilst I sound, quite upbeat about the new proposed changes, look, I'll just firstly say that, an increase to tax is, I guess, never welcome for most of our clients. But, the new changes seem reasonable, I guess, when you take into consideration that the super system was designed to help people save for retirement, and it's not meant to be a tax haven for wealthy Australians. So, the argument is, if you have more than 3 mil in super, the system has done its job and you can afford to pay a bit more tax. So the question is, what impact will this have on large super fund holders, the new proposed changes? So looking at the previously proposed changes, I think many large super fund holders would have been seriously considering withdrawing money from super to move investments into other ownership structures, such as personal name, in a company, in a family trust, or maybe even, giving money to children as an early inheritance. Initially, the government forecast that this new tax would raise $2 billion in tax revenue in its first year. And look, we questioned that. We didn't expect it to raise close to that amount of tax revenue because if you look at it, most of the super fund holders who are impacted, well, they would just withdraw money from super to avoid the tax. There was analysis that was done from the Association of Superannuation Funds of Australia, but it's been covered by a number of different bodies. And it showed that of the people with more than 3 mil in super, about 65% of them are classified as retirees, and about 90% of them are over 60. And as we know, retirees that are over 60, they've met a condition of release, assuming they're retired as well, which means the majority of the super fund holders affected by the proposed changes, they would have been able to withdraw money from super to stay under the 3 mil cap and to avoid the new tax. So we didn't really think that the previously proposed changes were going to be that effective in raising revenue as the government thought they would be, because people are smarter than you think in essence. And I think people that would be affected by this would be seeking some professional advice around what they should be doing. And I think a lot of the professional advice in many instances would be to avoid it and withdraw money from super. So under the new proposed changes, we think for balances between 3 to 10 mil, super still presents a very tax-friendly environment for most super fund holders. And I'll explain why. So for clients who fall into this range, and there's a bit of assumptions in this, but for clients that fall in the range of having 3 to 10 mil in super, they typically already have investments in their personal names, usually substantial investments in personal name. And those investments usually tip them over passive or whatever, any form of assessable income of $45,000, which would put them into a personal income tax rate of 32%, if you add Medicare levy to it as well. So the 30% tax rate in super is still more attractive for these individuals. Now, of course, there's going to be some individuals that have, between 3 and 10 mil in super and don't have any passive income in their personal name in retirement or income lower than 45,000. But I don't know, I think that's going to be pretty niche there. I think the majority of the individuals are quite wealthy and they've got other investments in personal names. So we're making some generalizations and we're playing to the masses here. And then from a capital gains tax perspective, super fund balances between 3 to 10 mil, they would incur a 20% tax rate. Now, in personal name, there's a bit of variance here, but this tax rate could range anywhere from sort of 16 to 23.5% as you move up the personal tax brackets. I mean, 23.5%, that's right up in the top tax bracket. In our experience, capital events, they're large and they're one-off amounts, often property or liquid assets, those sorts of things. And they tend to result in, at least roughly 20% tax rate in personal names. So, therefore, the effective tax rate of capital gains in super is fairly similar. So something we considered, which I'm sure many of these affected individuals would have, is the option of moving money out of super into a trust structure, potentially with a corporate beneficiary. And this is outside of the super environment. So, doing so and using that corporate beneficiary, this would effectively cap the tax rate at 30% because you distribute the income from the trust to that company with a flat 30% tax rate. And obviously, you'd only do that if there were no tax effective individual beneficiaries that were available. Obviously, if there was an individual available at a lower tax rate, personal income tax rate than 30%, you'd utilize them first. But, assuming there's not, it would cap the income tax rate at 30%, which matches that within super. So in this situation, it's possible that investors might pay slightly higher tax on capital gains because naturally you would distribute any capital gains to the individuals. You wouldn't distribute that to the company. You'd only do the income to the company. And right up in the top tax bracket, you're going to pay 23.5% after the 50% CGT discount in personal names. So, that's higher than the 20% effective capital gains rate in super in this bracket. But look, it depends on what other income the individuals have in their personal name. So it's possible that there might be slightly higher capital gains tax by having the investments in the trust. But then on the flip side, the other thing you've got to think about is the companies of which you distribute income to, they get credits for the tax pay. They get the franking credits. And, in our experience, franking credits are actually really, really tax effective and really, really beneficial in mapping out plans for clients. We've through the use of a corporate beneficiary, and as those franking credits build up over time, when you end up then in retirement paying out the dividends with the franking, it's actually really tax effective and not a lot more tax needs to be paid because of those franking credits. So you've got to consider that you get to hold on to the tax paid, which is the franking credits. But the other thing you've got to consider is super fund members, they'd need to pay capital gains tax in super to sell the investments. And how much they'd pay would kind of really depend on the balance. So, they'd be paying a 10% CGT rate for the balance between 2 to 3 mil, maybe anything under 2 mil. If they're in pension phase, there's no capital gains tax. But, there's a cost to be paid to transfer it out of super, of course. So look, in summary, from a tax perspective, we feel that for most people, it's unlikely to be beneficial to move assets outside of super to avoid the 30% tax rate that applies for super balances between 3 to 10 mil. That's across the board, and that's sort of generalizing things, but that's our view. The thing I haven't spoken about here a lot is, well, what about super funds with over 10 mil? And I haven't sort of touched on that too much because it, plays to a very, very small portion of, the population and probably the listener base. But I think the 10 mil is a bit different. Pretty much, it might be worthwhile taking money out. So depending on how much an individual has over 10 mil, if they're only breaching a little bit, it mightn't be worth it if you're going to have to sell a large asset. But, I think if there is a large portion pushing over that 10 mil cap, well, then I think that changes the dial, and it's probably likely that pulling money out of super might be beneficial for those individuals. So to the question, what should people do with large illiquid investments inside super? What should they do? And in short, I think the answer is probably nothing. It's our view that super funds with large illiquid investments such as property, they're most likely still going to be better off retaining these investments in super if they're under the 10 mil cap, as I've previously mentioned. This is largely dependent on the individual circumstances, of course, and this is not advice. This is all sort of general information in nature. But, I think for most of those people, it's fair to assume that individuals with over 3 million super would typically have substantial assets outside of super too. And if that's the case, then it's probably still going to be effective for most people keeping funds inside super. It's interesting to note there's going to be an increased pressure on liquidity, as I touched on before. The liquidity of super funds now with the additional tax on income. So even if you don't sell assets, just with the additional 15% income tax requirement in super above 3 mil, this might force some super funds to selling these investments in order to meet the tax bill bills and to meet their pension payments if they're in pension phase. So I think it really stresses the point of having liquidity inside super. But, if substantial liquidity is available, most super fund holders, we think, are still going to be better off retaining the investments in super for the foreseeable future. The other important consideration to keep in mind here is the impact of land tax. So self-managed super funds are assessed as separate taxpayers for land tax purposes. And this means that any properties owned by the self-managed super fund members in their personal name or in trusts, that doesn't impact the self-managed super fund tax liability. So therefore, an individual that has significant property exposure in their personal name, in a particular state, transferring properties from the self-managed super fund into their personal name in fact, will result in much higher land tax bills. So we actually assessed this for one of our clients. We had a look at the impact of, what would be the assessment of land tax if you moved that property from your self-managed super fund. And I'll state that this individual, the property was in the same state as all of the properties that he owns in his personal name. So there's that kind of bringing together, or that sort of aggregation of all of those properties in the same state. But yeah, we assessed the impact for that client, and we estimated it would result in an additional $17,000 of land tax annually if he was to pull that property out and put it in his personal name. So, this is all very dependent on individual circumstance, but for that particular client, there was going to be a significant increase in land tax. And that was obviously a deterring factor for that client, but we also assessed, the overall situation for them. And our view for that client was, no, they're better off keeping that property in super. So look, I'm going to wrap things up on this point now. That's the previously proposed changes. That's the new proposed changes. That's what we think about it. That's the implication, and that's what we think people should likely do. But look, in conclusion, we think the revised proposed changes to the super tax rules came as a welcome change. They certainly did to us and our clients. New taxes, as I said before, they're always met with concern and I guess nothing to be happy about. But we think the new proposed changes are a much more reasonable and equitable approach for super fund holders now and into the future. And I think the new proposed changes will likely see far less super fund holders being forced into selling investments and pulling money out of the super environment. I think the lesson here for investors is to not make knee-jerk decisions and not to react until changes are law. There have been some stories that we've heard through the ranks of clients, selling assets, pulling money out of super, giving it to their children to sort of get ahead of the previously proposed changes and to avoid the proposed tax. That's unfortunate. I wonder whether some of those people would look back at that decision and regret it because, they may not have needed to and might not have been in their best interest to do that. Some people are worried about putting money into super because they believe they're concerned the government will change the rules. And look, they definitely will. As we're seeing here, they will change the rules. I've met with some clients from time to time who are just staunchly against the super environment because they just go, I don't want to lock up my money because the government's going to change the rules in super and I won't be able to access and I'll be whacked with tax. Look, super is almost certainly always going to be a concessionally taxed environment. So it's just too good to ignore. There's going to be changes to it. And as we're seeing here, the government's making changes to it. But I think they're always going to keep it as a concessionally taxed environment, and particularly for the large cohort of the population. They've sort of gone targeting, wealthy individuals and high super fund balances in this tax here. But for the large portion of the population, it's always going to be a really good tax-friendly environment. So, if you're someone that has substantial wealth, you don't want to put all your eggs in one basket. You don't want to put it all in super, but ignoring it is not going to be the best avenue because there's great tax benefits in utilizing super, even still with the new proposed changes. All right, I'm going to see if I can squeeze in a couple of listener questions at the end here. So the first one comes from someone who'd like to remain anonymous. It's a follow-up question. So Stuart's already answered one question from this individual, and it's a follow-up question. I don't know which one that was to this listener, so we'll see if my answers align with Stuart's. But to give you an idea of their situation, so they're in their early 30s. They've got about 250,000 in shares or crypto. They've got an investment property in Melbourne that they bought a year ago. It's worth 900,000. There's a mortgage of 770 against it. It's a high yielding one. They've got 250,000 cash in the offset for that Brisbane property. They're currently rent investing. So they live in Melbourne. They want to buy a home in Melbourne. That's where they're going to live. And that's their goal, is to buy a home in Melbourne. They'd previously been considering, I'll just mention their incomes, combined family income of about 350,000 and some money in super, but not too relevant at this point. So look, current goal was to buy something in Melbourne in the sort of 8 to 900,000 range. Their current borrowing capacity, which I'm guessing they've had this assessed by a mortgage broker, is about 920,000 with a 10% deposit. So with Stuart's answer to the previous question, these individuals, they've been pursuing a villa or a battle axe unit for around about that 900,000, which is sort of a 2-bedroom in the suburbs that they're looking at. They've mentioned, though, upon gathering more information from your podcast, we've been happy to stretch ourselves a bit for the home budget, PPR budget, as we feel we might get priced out of the upgrade forever home in the future if we went for the unit. So it sounds as though what they're looking at, this sort of villa unit type thing, it would really be a stepping stone, and it's kind of not what they want to be ultimately long term. So that's sort of understanding what they're saying there. So the question ultimately is, how far should they stretch themselves for this PPR, for this new home purchase? So they've mentioned option one is sell the Brisbane property. So they've only had it for just under 2 years. Profit would be, 30 to 50 grand after CGT and costs and that sort of thing. I've given the address there, which they don't want us to disclose, but to this listener, I've had a quick look at it. My view, that's not bad. That property will work, I think. Yeah, I mean, this is not personal advice, obviously. This is just me having a quick look at things, but that looks pretty good to me. I reckon, you think about things like, the land value component, sort of the area that it's in, location, to amenities, all that sort of thing. I think that's not bad. That'll work for you, that property. The other option they said is, option two, sell the shares in crypto. So then they could potentially push up to sort of 1.2 mil to get a 3-bedder house on a 400 to 500 square meter block. This, they've mentioned, of course, would attract some CGT from the sale of the shares in the crypto. And then third option is, do we not stretch ourselves and do we keep some powder dry, for potential life changes in the future? So my answer simply to this anonymous listener would be, if buying in that 1.2 mil sort of target, that sort of 3-bedder on a 400 to 500 square meter block in the area that you're looking at in Melbourne, if that's going to get you, if that's going to make you happy and that's going to be the forever home for you, then I'd do that. Selling the shares, selling the crypto, you can build that back up later. That can come back later. I think you will regret not getting into that forever home as soon as possible. And to your point, if you're kind of stretched on your borrowing capacity at the moment, what happens if Melbourne takes off? And then you're always priced out of the market getting into that forever home. And I think you'll kick yourself for not having got into it as soon as possible at the current price point. So if selling the shares and buying for that 1.2 got you into that place that you're happy with, I'd do it. I would if it was me. Whether you sell the Brisbane, so that if that works, then great, and I would do that. Yeah, you pay some CGT on the shares and the crypto. That's what you have. That's the price you have to pay. But you can build that back up later. In my opinion, I think you're going to be happy getting in if that's somewhere that you're going to be happy long term. Selling the Brisbane property, well, I guess, that's the question is the 1.2 enough? Because obviously selling that would free up more borrowing capacity. There's not huge equity in it. You get a little bit of equity out of it, but it's going to free up more borrowing capacity because you're getting rid of the debt. So you'd only do that. You try and avoid transacting on property. In my opinion, the priority goes liquid assets first, because you can sort of sell down upon that in different increments and that sort of thing. But selling property it's costly. Like to get back into the market later, the stamp duty and the selling costs, all these sorts of things. And that property in Brisbane doesn't look too bad to me. So if you can avoid selling that and selling the shares still gets you into the market, do that, I think. And then as for the third option, don't stretch yourself, keep some cash, that sort of thing. No, I don't think so. Sometimes you got to stretch, you're at a point where, and I think everyone, when they're buying that forever home, I've done it as well. My wife and I, we really stretched in buying the forever home, and you get in, it's a big mortgage. We had to really move things around to make it happen. But then, you start building up afterwards. We start building up our position, and we're very happy that we've got that locked in at the moment, and we're going to be happy there forever. So, I think it's always going to be a stretch, but I would do it. Yeah, I think I would. I hope that helps. And I've probably got time for one more listener question here. So this listener would also like to remain anonymous. They start off by giving some really nice feedback about the podcast, so thank you for that. Look, the background on their situation, they write, I'm 40 years old and I'm in the highest marginal tax rate, maxing out concessional contributions every year with surplus cash flow. I invest about $3,000 a month into some diversified index funds, VAS and VGS, which are Vanguard, great. The ETFs are purchased under a family trust. I aim to do this for the next 20 years. My wife, who's also 40 years old, is in the 30% tax bracket, and we have 2 young children that are both under 10 years old. So question 1, and I'll sort of address them point by point. What are your thoughts on investing shares under the family trust instead of a non-trading investment company? I'm not sure if I should sell all the shares and move them into a company. No, I don't think I'd do that. I'd sell them and move them into the company. I think I'd keep them in the family trust. I think I like that. With your wife in the 30% tax bracket, you wouldn't really be getting much benefit in distributing the income from the share portfolio in the family trust to a corporate beneficiary. Like it's 2%, because the marginal tax rate once you add the Medicare levy is about 32% to your wife. So we're talking about a 32 versus 30% on income. Not much. That's not going to warrant the benefit of setting up a company and paying ASIC fees, that sort of thing. I don't know how much you've got in this family trust, but I'm sort of make some assumptions. It's under $1 million. I think it'd be less than 500,000. I'm guessing here, but no, I think investing in the family trust is the right thing to do there, and I wouldn't go selling them, because you've got to consider as well then capital gains. It's when you've got them in the family trust, you can distribute to an individual, which is much better than having it in the company. If you sell them, it pays a flat 30% tax rate versus 23.5%, even if the individuals were right up in the top tax bracket. So I think keep it in the family trust there. Second question, if we decide to purchase a business, are we able to use the same family trust as the one we're using for share investing? I guess you can. Nothing wrong with that. It's a bit of a difficult one there, because it really depends on what the business is. It might be better off having that business in its own company, perhaps. It's sort of a difficult one to answer, because it really depends on the business, what it is. But it might be worthwhile having it in its own company for a bit of separation, a bit of reducing the liability, and a bit of asset protection. So having it in that company structure, and then it also helps you if you're ever going to sell that business as well, because then that entity can just be sold off. But you would still want to channel it through the family trust. So you'd have if you had it in a company, you'd have the shares in that company owned by the family trust. So then the dividends can get paid down into the family trust and then distributed accordingly. So the other difficult element is it depends on whether the business you're purchasing would then constitute personal services income. So if it's like like a trade business or something where you are working and the income is therefore a result of your personal exertion, there's issues there with personal services income. That changes the dial a little bit. But I guess to answer your question directly, are you able to use the same family trust? Yeah, you can. Yep, you can do that. Then final question, once the business is generating a lot of profit and we want to create a corporate beneficiary and move the profits from the family trust to this entity in order to cap the tax rate at 30%, if we decide to pay a dividend in future from the company, do we have to create another family trust to do this? No, not necessarily. You can, but no, not necessarily. How it works is when you set up that corporate beneficiary, you would have your original family trust. You could have the original family trust as the owner of the shares in that corporate beneficiary. So what would happen then is you build money up in that corporate beneficiary, then you reach retirement and you go, okay, we want to pay out some dividends and release the franking credits from that corporate beneficiary, sell down some of the investments in it, that sort of thing. Therefore, you pay it out to the shareholder of the company, which is the family trust, and it goes to the family trust. And then from there, those dividends, you then have flexibility from the family trust in where you distribute it to. Now, there's also alternatively nothing wrong with having a separate family trust, which is the owner of the shares of the corporate beneficiary. So it's not totally necessary, but it works kind of the same way. You've kind of just got an additional entity, really. So you probably don't need to. But it would work the same way. But I think for most cases, it's probably not worth doing. You just would have the original family trust as the owner of the shares in the corporate beneficiary. Okay, I'm going to wrap it up there. I hope that's helpful to that listener and all the other listeners. Until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.